everyone, and a warm welcome to this PIC Perspectives Dialogues with me, Musidi Mudise. Today, we're going to be unpacking a piece of research that the PIC commissioned in collaboration with Oxford University that was titled, Can Institutional Capital Spark Africa's Next Industrial Boom? So I'm joined today to have this discussion with the co-authors of the paper, being Geoffrey Nölting, who's the senior economist at the PIC. Joining us as well is Dr. Brian O'Callaghan, who's a senior fellow at the University of Oxford. Delphine Govender, who's the chief investment officer at Perpetua Investments. We're also joined by Sanisha Pakrisamy, who is the chief economist at Momentum Investment Group. And last but not least, we are joined by Pamela Mondliwa, who is the head of research and information at the Industrial Development Corporation. A very warm welcome, everyone, here on Asset TV. So to provide some context about this paper, I'd like to open up the discussion with two of the co-authors, being Brian and Jeff, just to get a little bit of context. So starting with you, Brian, from your research that you've done a number of research initiatives at Oxford around economic recovery and industrial policy. What global shifts have kind of signaled to you that now is the time for South Africa to prioritize industrialization?
Yeah, thanks, Masidi. Before I start, the lawyers tell me I need to remind you all that I'm an investor in the US, but I'm speaking here as a human being in my academic capacity at the University of Oxford. None of this is investment advice. It's just one guy with a spreadsheet and too many opinions. So here's the headline. South Africa is reforming. It's reindustrializing from a strong base. And in our view, opportunities are mispriced. Now, under the guise of a working paper series, Jeff and I have been working with PIC on a paper looking at what specific opportunities are available to investors to take advantage of industrialization in South Africa. We think that on a risk-adjusted basis, in short, there are differentiated returns on offer for smart investors in South Africa, and we've documented in this paper what some of those areas of focus might look like. I think if I was to summarize it in one word, we're saying that the South Africa we see today is no longer in the risk basket, it's in the correction basket. Now, to help set the scene, Masidi, as you suggest, and as we do in the paper, here are three kind of global themes that I think are underpinning industrial policy right now. Number one, we're seeing security over efficiency. And this is this is lasting since COVID. After decades of, the just-in-time movement in manufacturing and production, the world has swung back towards just in case. And so resilience in supply chains is now very important, and that outranks marginal cost. The second big theme that we've noticed and speak to is capital nationalism, right? Every major economy is using their fiscal muscle to anchor production at home. You see that in the US, you see that in the EU, you see that in Japan, and that invisible hand has really been playing a larger role than previously. And then we also speak in the paper to a few more sectoral thematics that we see underpinning global transitions. They include decarbonization as a form of competition, this race for net zero, which is really just a race for manufacturing share, at least in part, and then also themes like artificial intelligence. So that's how I set this upfront context.
Great stuff. It's a nice macro view, and it's a great way to maybe bring Jeff in to bring it home. So, Jeff, this paper was driven by PIC's motivation to quantify and act on South Africa's industrial potential. Could you walk us through what inspired this research from a PIC perspective and how you built the analytical framework and rigor behind it?
Thanks, Musidi. It's a great question. So I guess the inspiration for this research was pretty simple. It was connecting two major imperatives. The first being the urgent need to revive SA's industrial base. And then secondly is the fiduciary duty of institutional capital, such as pension funds, but also sovereign wealth funds, to seek attractive risk-adjusted returns for millions of beneficiaries. So our paper attempts to show that these two goals are not mutually exclusive, but rather they're intrinsically aligned. We believe that industrial growth is a structural tailwind for long-term value creation. So if we look at some of the findings there, our research shows a clear and measurable link between investment and economic impact. We also developed a framework to measure the potential impact, economic impact and investment impact by modeling various scenarios across the industrial manufacturing value chain. I guess the key takeaways that we've got is that if we are able to successfully double South Africa's industrial investment by 2030, then the economic multiplier effects are immense. We project that we could generate about 100 billion Rand in additional manufacturing output, and that will directly lead to the creation of just about 250,000 jobs. And I think more crucially, the projects deliver the attractive risk-adjusted returns, obviously demanded by long-term investors. From a PIC perspective, we would like to position ourselves to be a catalytic converter in terms of deploying focused and targeted capital to de-risk and unlock South Africa's industrial potential in these high potential value chains.
Thanks, Jeff, and thanks very much, Brian, for that, like setting up the scene. And I'd like to zone in now a little bit into the work that the IDC does. So, Pamela, coming to you, as the IDC and a developmental finance institution, you well positioned to support initiatives that advocate for industrialization. So, there's a lot that's been discussed in the paper, and I'd like to get your view around how you are maybe kind of supporting some of these strategies that are being proposed and being deployed or employed.
Thanks, Mosidi. So first of all, we'd like to say as the IDC that we very much welcome this research from the PIC and the collaborators at Oxford. It very much aligns with international debates on the importance of industrialization for sustained economic growth that South Africa so sorely needs. And we know this because leading up to COVID, for instance, there was increasing emphasis within economic literature on bringing production, which is about industry, back into development debates. And then when we saw the shocks that followed from COVID, as well as the geopolitical tensions, we saw further emphasis, including within developed countries, on the importance of supporting productive industries as a part of achieving economic resilience and sustained development. As development finance institutions, we've then been called upon to solve for the development challenges, but also drive the thinking as well as the investments in these areas. And some of the key development challenges that I'd like to highlight and where there's opportunity to collaborate with institutional investors in solving for include things like learning effects, which are the time it takes to achieve economies of scale and scope in a number of industries, underinvestment in new industries, particularly in that period before the development of the ecosystem, as well as achieving economic dynamism by supporting challenger companies within the economies. So solving for those problems requires patient capital. This includes taking equity in businesses, but also providing longer repayment periods. And with South Africa's development finance institutions tending to have limited balance sheets, successful alignment with institutional investors then becomes so important for achieving the scale of investments that are required. It also allows for us to collaboratively cover the different financial needs associated with different types of firms, sectors, investment maturities, and risk profiles. So as the IDC, we've already mapped out our sustainable industrialization pathways, including cross-cutting enablers for the pathways, and stand ready to work with institutional investors. And important to note is that some of the sectoral priorities that are identified in the paper fit very well with our pathways, and I can unpack this further in the conversation. Thanks.
Great stuff. Thanks so much. And Delphine, I'd like to bring you into the conversation as you sit squarely within the asset management industry, but look at both the retail and institutional side. So when you look at this paper and what it proposes, how should South Africa strategically position itself to attract capital for industrialization? What would, in your case, make sense given the type of practical capital you need to kind of deploy in order to create risk-adjusted returns for investors?
Yeah. Thank you, Masidi. And thank you to the authors of this paper. I think it really brings to the fore many of the critical topics that investors would really love solved for, to meet their ultimate kind of dual objective, which is, as you say, kind of meeting those targeted risk-adjusted returns, typically, meaningful real returns, but at the same time, sourcing those returns in a diversified manner. And this has really been kind of the nub of issues, particularly for domestically oriented South African investors or investors investing into South Africa, even if you are foreign. Foreign investors, and therefore who is the investor also matters. Foreign investors are typically looking to South Africa as an emerging market to provide kind of a growth that perhaps might not be available, given the nature of the construct of this market, but also to deliver a form of returns that would perhaps not be correlated entirely with developed markets, as an example. The second thing is that domestic investors tend to be very focused on investing their portfolios, and particularly whether institutional or retail, aligned with almost the weightings of those represented sectors in the benchmark. And if you look at our standard equity indices in South Africa, they are currently, given the rise in, for example, the gold price and the platinum price, currently have quite a high weighting, for example, to commodities. So about a third of kind of the equity benchmark, which is under a third, is commodities. A big chunk to financials, also another third. And then the remaining third is split, quite almost widely between various other sectors, your consumer sectors, your consumer discretionary. But what is significantly underrepresented in our benchmark, which almost is the baseline against which institutional capital invests, are industrial stocks. So industrial stocks, your food producers, they probably, if you add them all up together, don't even get to a double-digit percentage of the South African equity benchmark. And why this starts to become, interesting and potentially a massive opportunity is that we actually are significantly under-indexed to the extent that a country that really represents our potential for growth, where we are in our life staging of industrialization, we really should have a higher allocation to kind of investment opportunities into the industrialized sector. And that's a vast catch-all area. I am conscious, for example, that even in the material sector, really is more gold and platinum rather than your general miners that is dominating that sector. And in South Africa, having been a commodity-producing, export-oriented nation and economy, all those trickle-down effects that come from typically when commodities have been in boom have typically shaped how the other downstream industries perform. And so if we really want to move to a more diversified market, we really have to also potentially move to a more diversified economy that is then represented in the public equity space. So for me, the exciting opportunity is if we can almost start to re-index the right share that the industrial almost sector, that we call it the indie sector, should be representing. Because if it were representing larger kind of turnover, larger earnings pool, larger profit center, which it should, you would find that the institutional capital would gladly shift there because it would provide very much diversification benefits. The last point to note for South African investors is that we have this large cohort of, or we call them, non-South African, non-commodity companies that are listed in our market, which actually have no connection to the South African economy at all. And yet they consume a large chunk of institutional capital because they tend to invest alongside benchmark weights. And my sense is that that same capital, particularly given asset owners are becoming a lot more conscious now around the impact elements as to not just the return element, but the impact element of where their capital is going, would gladly seek to find a home in profit centers that are domestically oriented rather than these almost multinationals that are global beverage companies, global manufacturing companies, global consumer companies. So a couple of almost opportunities that absolutely exist largely for institutional and retail capital if we had almost the right weighting of industrials in the available benchmarks.
Great stuff. That's very rich context. Yes, yes, Brian.
Just to come in here and reaffirm the point that Delphine is making with regard to asset class correlations. We looked in this paper at historical risk-adjusted returns, we looked at development opportunity, but we also looked deeply at asset class correlation. And if viewers are interested to go to the paper, the very first figure, it's very colorful. It gives you this correlation map of South African sectors versus each other and also versus international sectors. And the correlation between each of those and South African industrials is the lowest in almost every case across the board. So when you talk about portfolio diversification, this is a space that we certainly think has been underweighted in the past.
I think, yeah, there's just such a great synergies around how you've all tied up the case for industrialization and the how of it from an investment perspective. But I'm glad to be having you, Sanisha, as an economist in the room, where I'd just like to kind of spotlight that the paper, says that we have the opportunity to reach this industrialization boom by 2030. So it's a 4-year window. So as an economist, watching closely what's happening at a macro level, how ripe is South Africa, given the macro environment, for this bold industrialization strategies?
Thanks, Mosidi, and thanks for the opportunity to chat about this interesting paper. I think the world economy is quite prepped for a big sort of reindustrialization theme, and it comes from a couple of aspects. So, from an economic aspect, we know that global growth is slowing this decade, as the World Bank has stated, is likely to be the slowest growth decade that we've had since the 60s when the World Bank data began. And so that means that economies are starting to look towards inward resilience and looking to have policies that actually can promote internally led growth in an environment that is shifting so drastically. Secondly, we've had an enormous AI technology boom, which has led to an uptick in productivity. So the types of manufacturing or industrialization that we're thinking of is probably not the same as the traditional ones that we were used to, but rather the advanced higher value add tech that is now instituted into the manufacturing and industrialization sector. Thirdly, we've also seen massive shifts on a geopolitical scale. And that means that, countries are now looking to national security issues. They're looking towards protectionist policies. And so that means that we also need to see some industrial sovereignty coming back to economies around the world. And then fourthly, there's also an issue around, the green rethink, ensuring that we are ticking the boxes on the environmental regulations and ensuring that we are also investing in the spaces that would have traditionally been underinvested in order to cover all our bases. Of course, South Africa in that context has a couple of pain points. So we know that, corruption is an issue and that can deter foreign inward investment into South Africa. We also know that South Africa has a skills deficit. And so we do need to ensure that our regulatory and economic environment is enabling for that investment to take place. So as an example, if we have a skills deficit on certain areas of the economy, to ensure that we've got a visa regime that allows for the inward movement of these skills into the South African base. Looking at the reliability of our energy, logistics, water sector, and all three of those are quite pivotal to a reindustrialization strategy. So for South Africa, there are a couple of pain points in order to get this going. But I would say that the time is ripe for the global economy from those four aspects. This is the time that economies are becoming more inward-looking, looking to increase economic resilience through policy-induced measures in a world that is becoming, geostrategically aligned in a different way.
And coming back to my point around the timing, is a 4-year window realistic, or should we be aiming, given how the way things work in the country, taking a longer term view on what is possible?
Well, I think what's tough for South Africa is there's a long list of priorities. And so I think we need to be quite clear about these. So do we want growth or do we want profitability? Do we want high-end value-add manufactured products, or do we want to grow jobs across the economy to match the skills that we have currently? So a 4-year period is quite a short period of time to reskill workers in order to orient them into a high-tech manufactured goods sector. It's also quite a short period in time to ensure that, let's say, beneficiation is more competitive in SA relative to some of the global players like China, which plays quite heavily in that market. So the time frame is quite a constraining one, but that does mean that we then need to be quite clear on the list of priorities and what we want to achieve within that time frame. We also know that in South Africa, the 4-year time frame also includes some political uncertainty. We do have the national elections, which will be taking place in 2029, and that could usher in a new era of policy direction. And of course, that will also then determine the success of a reindustrialization policy here domestically.
Thanks for that, Sanisha. I'd like to now unpack the deep dive that Jeff, you and Brian did around some of the sectors where this industrialization focus could really benefit the country immensely. You highlighted quite in depth around around manufacturing, agro-processing, and the automotive industry was all there. When it comes to manufacturing, the paper reveals that South Africa's manufacturing has been in decline, and this stems from low demand but not limited capacity in any ways, signaling that there is untapped opportunity for growth. So, Jeff, from a PIC perspective, what's driving this underutilization? And given that this is a discussion around investment catalyzing opportunity, how can we revive that industrial capacity to create the jobs that you say are possible to attain?
Thanks, Masidi. Maybe I'll put on my economist hat for a moment. I think what's keeping investment in infrastructure and manufacturing down is really lack of investment in economic infrastructure. We've got obviously issues with our energy, but also our logistics networks. We really need credible policy to kick in. We know that South African companies are sitting on about 1.5 trillion rands worth of cash on their balance sheets, but they are looking around and not seeing very many places where they would want to invest. So I think we are starting to see political buy-in. We have seen a number of political parties releasing their economic plans. And I think quite encouragingly, it's still early days, is that we are starting to get that political buy-in. And I think once we see that, South African and international investors are certainly ready to deploy. I think an important crux to that is, or an addition, is that, South Africa gets bundled in with the rest of Africa, which was probably not correct. We've got a lot of these factories and industrialization targets already met before. We aren't starting from the beginning, and I think that's a crucial aspect that we need to take factor in.
Yeah. And Pamela, as IDC, you've been central to financing industrialization. It's a key or core mandate of yours as a DFI. What are you seeing, or where are you seeing momentum, and what sectors are demonstrating real progress? And it would be interesting to get your view around the ones that were mentioned in the paper, being manufacturing, automotives, and agro-processing.
So, industrialization is our core mandate, which means that we, since 1940, when we were established, we have been working towards supporting the industrialization of the economy. And we have invested in some of the biggest firms, industrial firms within the country, and continue to do so in various ways. So, thinking about where the world is and the challenges that both South Africa as a country, but the world is facing, we were faced with rethinking our strategy and approach. And what are those key challenges? So, from a global perspective, you've got climate change, which was already been mentioned. And there are two important risks that stem from climate change. The one is transition risks. So, you've got changes that are happening from a technology perspective. You have changes in terms of regulation, which is shaping competitiveness and access to export markets. These are things such as the carbon border tax adjustment mechanism in Europe, and Europe is an important a market for South Africa's production overall, and various other transition risks. But you also have a physical climate risk, so which means that your agricultural sector is facing some challenges, given that Southern African temperatures are increasing at 2 degrees higher than the global average. So there's a lot of investment opportunity in those areas to support both climate and economic resilience. But then we've also got the long-standing challenges that we have as a country. This is the trend of deindustrialization, which is well outlined in the paper. We've got the socioeconomic challenges of poverty, inequality, and unemployment. That we all need to really address. So we thought about, how do you go about looking at environmental issues, the socio-economic issues, as well as supporting sustained economic growth. And through thinking about that, we were able to design the 4 industrialization pathways for South Africa. And these are a low carbon and green growth. So here we are really looking at, how do we support the transition of the economy, and also how do we support investment in some of these new areas, such as green hydrogen, critical minerals, which offer an opportunity to diversify even within mining. For which I think Delphine mentioned some of the issues that we're seeing there. So some of the pricing of the older commodities are coming down, but the prices of the newer commodities are on an upward trend. So how do we leverage on that and support the investment opportunities in those areas? But this also includes transitioning existing businesses. So the South African economy is emissions intensive, which means that quite a number of our industries have some way to go in terms of reducing their emissions in order to stay internationally competitive. So there are investment opportunities there, and this is actually quite important for the institutional investors, because you're exposed to some of these companies, and if you are to have sustained dividends and financial returns in the long run for those companies, there's interest in investing in their transition along the way. The second, actually, it's the first pathway, is economic diversification. So South Africa is an interesting country in that we have deep productive capabilities in a number of areas. For example, machinery and equipment, right? It started out with the link with producing machine and equipment for the mining sector, but has evolved and developed over time. And there's great opportunity to be able to grow and deepen those capabilities. And so there are much investment opportunities there, but also in supporting the structural change of the economy or the diversification. There is opportunities to simultaneously reduce emissions, because those are industries that tend to be less energy intensive, but it's also industries that tend to be more labor absorbing. So by targeting those type of productive industries, you're hitting all 3 of the marks that we are trying to hit. Then the third pathway is around regional value chains. This is important because South Africa's fate is very much tied to the region. Why? Well, about 40% of South Africa's manufacturing exports go to the region, right? And there's some of the countries within the broader region are growing much faster than we are. So a low-hanging fruit is for us being able to better integrate. But we need to take a regional perspective about this. It's not just about South Africa sending more goods to the region, but how do we develop and support the deepening of regional value chains, within the region? This is mutually beneficial, and also supports demand for other products from South Africa. So as economies grow around us, as well as they urbanize, they require consumer goods that are largely still coming from South Africa. So this presents quite a number of opportunities. Then the last pathway is around supporting economic and climate resilience. So here is supporting firms to adopt and adapt and innovate technologies that can support climate resilience, but also thinking about resilience of some of the other industries. So we've also got cross-cutting enablers linked to infrastructure, digitalization, and really how to think about supporting the development of ecosystems. So I think with the work that we've done, but also the investments that we've done in these areas, we are able to share our experiences with investors, and we co-invest much of the time with some of the commercial sector. We also partner with PIC on a number of investments, but I think it would be helpful for us to be able to really share more of our experience. I can give you an example of something that hits quite a number of that pathways. So if you look at our critical mineral value chains, right? So South Africa has some critical minerals, but some of them lie outside of our borders, right? There's a strong reindustrialization opportunity that arises from that. But when we look at it from a regional perspective, it really does get bigger. Right. And so we've mapped out all the critical minerals in Southern Africa as well as the refining capacity. So this speaks to the issue of beneficiation. We've started investing in some of these areas, and in some areas, we are able to secure offtake agreements for some of the downstream beneficiation, just supporting the creation of those linkages. So we're supporting both diversification at the same time, both from within mining, but also down the value chain from a structural transformation perspective, but at the same time supporting then the regional value chain perspective. But it's also supporting a lot of these new industries that are formed. So if you look at the demand for copper, for instance, is really on the rise. The demand for various minerals such as manganese that are linked to lithium, to some of these new products that are in high demand from the globe. That's where we can play, because these are the industries that are really going to grow quite substantially in the near future, and allows opportunities for South Africa and other investors to tap into that and really benefit from that, from those investments. One last point I'd just like to emphasize is that we've mentioned also a number of the pain points, and they are real and must be addressed. However, it's also important to emphasize that there are investment opportunities in solving for those pain points as well. And we should really be engaging and thinking about how we can co-invest or really find those niches that private sector funding as well as DFIs can come in to be able to support that. Then, with regards to the discussion, and this comes through in the paper around the underutilization of capacity in the manufacturing sector, it's also very important to understand what contributes to competitiveness of industries, right? Because you've got that underutilization, but at the same time, you've got import penetration in a number of industries that is relatively high in South Africa and in the region altogether. So there are opportunities for supporting investments in upgrading the competitiveness of firms, which would really allow them to be able to replace at least some of the imports that are coming into the country and the region, but also allow them to export more. So if you think about the current issue around the trade tariffs that are coming from the US, everyone is talking about what this means for exports to the US. A conversation that we're not having enough is what this means for increased competition in the country and in the region. As globally, all countries are thinking about how to diversify their export markets. This will tend to have increased, competition in markets. So really supporting competitiveness investments. This is anything from technology adoption and adaptation, from process improvements in these firms to really allow them to become more competitive, as well as in new challenger firms that support dynamism in markets, which in any event incentivizes firms to stay at the technology frontier.
Great
Thanks.
stuff. Well, you've unlocked a lot of the cases and opportunities, Pamela, so eloquently and in depth. And I would love to, before I segue into unpacking the competitiveness aspects and how does South Africa leverage industrializing to be a strategic competitive advantage. One thing that Brian mentions, you mentioned it in the paper around a lot of South Africa's barriers are actually internal. The policy failures and weak manufacturing resilience it has got nothing to do with external shocks, really. So, what are the first policy or institutional shifts that you think are needed to reverse these trends and tap into these opportunities that Pamela outlined?
Yeah, I think we say manufacturing was once the powerhouse or part of the powerhouse of the South African economy. But SA has just never recovered from the external shocks of the global financial crisis nor of COVID-19. Jeff's put this incredible figure in the paper that shows manufacturing drop and not recover, drop and not recover. So the external shocks forced some of that on SA, but the lack of recovery, that has all been internal. And our view on why is two-part, and we need to be honest with ourselves. Part one is just an issue of past policy decisions that didn't keep pace with global economic development. And part two, it's about downward trends in electricity and transport reliability. But this is more a good news story than a bad news story, I think, because we've seen significant improvements in both of those internal spaces, and we see dedicated conviction in the current government to continue in that vein. So what do we need going forward? I think we need to be focused on capacity and capability. Our capacity for manufacturing, both existing and growth potential, is immense, right? In the paper, we call this latent capacity. As reforms are undertaken in electricity and in transport, the capacity that the country has, again, this is not us industrializing for the first time. This is re-industrialization. So that capacity, that latent capacity, is slowly being unfurled. It's a flower reblooming. And I think for investors who can position themselves alongside that budding flower, it's really an incredible opportunity. So I think it's a simple message, and I'm just repeating what I said before. South Africa is reforming, it's re-industrializing from a strong base, and that's supported by existing policy. As a result, opportunities are mispriced, and folks who position themselves well for that correction stand to gain.
And that's a market opportunity for you, Delphine.
Absolutely, it is an opportunity, and I guess one of the things that I was, thinking of as I listened to my three panelists were why did we get to this point of sitting with South African companies with all this cash sitting on their balance sheets and not being put to productive use, given that there's clearly a need? Why we got to this point has just been alluded to as to why we have all this latent capacity. So it's not as though we're operating at maximum capacity and we need to lay down new capacity in order to meet demand. What have been those blockages? And the truth is that, which is well publicized, and I think what's great about South Africa is that we are very much willing to look in the mirror and look at where the issues are and then put them on the table and address them, which is exactly what is happening if we look at, for example, Operation Vulindlela. But at the heart of it has been a very low level of business confidence. So when we speak to the corporates who have this kind of excess amounts of cash on their balance sheet, who are sitting with capacity or even products which have very low per capita consumption, who are very well aware that if they were to produce more, they would actually almost stimulate demand. The real issue has been for quite some time is this lack of ability to trust and rely on infrastructure that would run these plants, or if they were going to commit capacity on a multi-year expansion project. Could they, would the labor laws allow them to operate contract staff? Would they have the sufficient skills through visa reforms to get individuals, whether they would be engineers, to help, develop the plants? Would the lights stay on for them to run 3 shifts a day? So these have all been absolutely real kind of blockages, not to be kind of the negative person in the room, but that's the reason we've almost had this kind of plateauing of low levels of industrialization from the corporate side. All our experience with many of the South African companies that we invest in, they spent a huge amount of time and energy trying to externalize and move to other countries, whether it be Australia, Eastern Europe, outside of even the continent, and have not really had a really strong track record, particularly manufacturing companies. And in fact, most of them have decided to come back home. And the last thing they really need, because they do believe that their consumption opportunity is here, given the young population, given the opportunities in the different categories. And the thing they really need is to be able to trust the system of government delivery to then do their part, which is to put the idle capital to work and utilize existing capacity and then lay on new capacity. So those are the real things that I think we're definitely in the process of addressing. We've started to see, more consecutive days of no load shedding, all of those realities. And I think we're alive to the reality, but there's that last leg now to totally rebuild business confidence for people to make these kind of capital expansion decisions with comfort.
Yeah, and to say that I suppose there is an urgency to it. That's why this paper is quite topical and pointed. Like as short as 20, 30 years, it's like there's an urgency to it because the world is rapidly opening up and globalizing. And I'd like to segue into what these things around tariffs mean for South Africa. Pamela primed the conversation, a few seconds ago around it. And Sanisha, my question to you, like, given these current global trade shifts, we've spoken a lot about or are looking at what the Trump administration is advocating for. And when it comes to the US, AGOA is a question mark at the moment as we speak. We don't know whether it will be renewed or not, which begs to ask the question, should we be looking at regional integration? That's where the Africa Free Trade Agreement comes into play. So how should South Africa, position itself to accelerate this industrialization agenda and also start maybe leveraging some of these trading blocks to plug into global value chains?
Well, I think, a good starting point here is to see what is the environment for global trade likely to look like for the remainder of this year and going into next year. And I think we were all kind of positively surprised by the extent to how the global economy has performed for the first half of the year. But I think some of that performance is artificially boosted by quite a lot of front loading of imports that have taken place, preemptive of the tariffs that were going to come through. And so when the World Trade Organization released their October estimates not too long ago, they basically upgraded the overall world trade of goods for this year up to about 2.5%. But a lot of the pain is going to fall into 2026, when these tariffs truly kick in. And we're likely to see that world trade volumes are going to fall below 0.5% for next year. And so that, is the backdrop that we are operating in. And that means that we've also got to then look quite carefully at the opportunity set. As Pamela pointed out, building on those regional value chains is quite important. We can't just, say that it's market access that we want. We need something else on the table, such as maybe even developing infrastructure. And I think that is something that can then help us to really bridge the divide within SADC, to really leverage off the African Continental Free Trade Agreement. Within that, we must also understand that trying to build new free trade agreements or to leverage off the pre-existing ones can take some time. So I'd like to give an example. We were looking at a preferential trade agreement with India in 2000. Some of those negotiation points are still being deliberated upon today. If we look at something like the Southern Custom market, which is the Mercosur agreement, that took 3 years to kind of put together. Now, Mercosur is trying to put together a trade agreement with the European Union, and that's 25 years in the making. So we've got to look quite carefully at bilateral trade agreements, I would say. I think the world has more moved away from the multilateral trade agreements and moved more into a world of bilateral trade agreements. And just like we're doing with repairing our relations with the US, sometimes it's not just about trade policy. Sometimes it's about investment opportunities. Sometimes it's about building an economy that is attractive for inward investment. So the US is a great example here where, a few of the things that we need to put into place in order to make South Africa attractive for the US is not necessarily on the traded goods sector, but they've pointed fingers at our expropriation bill, saying that we need to change something around the nil compensation part of that. They've pointed fingers at taxing capital on arrival through Black empowerment policies that are not always conducive to inward investment from foreign capital. And a lot of this also leverages on the type of skill set that we have in the rest of the world, such as foreign trade representatives. So, we've got 43 foreign trade representatives that are missing in the global environment. So, who has championed the cause of putting together these trade agreements? With America, the sense of urgency to put into place an ambassador is not quite there. And so we need to have, these dominoes stacked up more favorably in order for us to secure some of these trade agreements in a world environment that's, shifting. So, the argument is that globalization is dying, but I think globalization is just taking a different form, where we're starting to see these geopolitical alliances being formed on a different way. So we're seeing new regional blocks forming, and we need to up our game in terms of what we are offering the rest of the world in order to make it attractive for some of these trade agreements to come into place. So, not to harbor on the point, but essentially it is to provide an environment that is conducive for the private sector to invest. So enabling the electricity reliability and availability, ensuring that we've got clean water supplies. With regards to the logistics network, I think we've made significant strides in order to get the private sector in. But of course, there are still some issues around the maintenance backlog, the fact that some of the trains can only run at 10 kilometers per hour because the infrastructure can't really support it. So, looking at that 4-year time frame and coming back to that 2030 deadline, quite a lot of what needs to be resolved in the transport and logistics sector, may only come through in the next sort of maybe 2 to 3 year time frame rather than an immediate time frame, and that then does, of course, make the 2030 deadline quite tight. If we look to the other countries and experiences that we've seen there, and a couple of these were quoted in the paper. Vietnam has a model where they basically had a plug and play for foreign direct investment to come in. Now in South Africa, if we want to get that foreign capital in here, is there an electricity connection that's working? Is it easy to set up business? There they have, the special economic zones. In South Africa, we've got the special economic zones, but in some cases, they're also underutilized. We don't have the luxury of saying that we've got low labor costs, and that's to the point around ensuring that we can have labor participating with a regulatory environment around it that's also conducive for the private sector to play. In Indonesia, what they basically did was had targeted incentive programs, which we can also put into place here, having a focus on sort of the green energy, which we can also do in South Africa and replicate here. But what we can't really do here, and the paper also touched on this, is to explore things like export bans. Now, Indonesia is quite a big market, and I hear the point that South Africa has a young consumer market, but it also is a young unemployed market, and so we do also need to think about our reindustrialization strategy, including quite a big export component to that. Bringing it back to whether pension funds can invest in such a strategy, there are also risks attached there. So let's say we want to go with an export-oriented world, especially with the going into the Africa region. This then introduces another risk of currency risk, as an example, trade dispute risk, as an example, and so that also ups the risk for pension fund money to be fully invested in that strategy. And the paper outlines that perhaps we need to have some offsets for political risk. But I think that also then tells us that for a commercial strategy, there is still quite a lot of risk embedded here.
Thanks for that. And just to touch on briefly to the automotives industry, like Sanisha raised a very good point around the case for Indonesia and Vietnam. And you mentioned it in the paper as well, Brian, like what South Africa can learn around enhancing its competitiveness, perhaps not with business as usual, but maybe leveraging that the future is, in EVs. What are both your thoughts, or what can you and Jeff share around that opportunity for the automotives in South Africa?
Yeah, I think as one example of these broader sectoral trends that we see South Africa well placed to take advantage of, decarbonization, including through electric vehicles, does come to the fore. When I think about that with a macro lens, I think about South Africa's combination of critical minerals access thereto and doing such in a way that protects human rights as well, right? That's differentiated. Our renewable resource potential, which is being taken advantage of through the Just Energy Transition Plan and other federal programs, and then also the institutional depth that we have. Combine those three things, and I think that this really is a premier emerging market destination for green capital. So SA, supported by the government, partnered with the EU, the US, the UK, and various others in developing the Just Energy Transition Plan, or the first global JET-P, to mobilize, I think it was 1.5 trillion rand to decarbonize power and heavy industry. I bring that up because it's both government supporting this and the signal of international partners saying, yes, we agree, there's significant opportunity. Yeah. We in the paper look at critical mineral beneficiation before even getting to the EV expansion as a key area of potential focus. This is really anchoring battery, potentially hydrogen supply chains here domestically, locally. And that's becoming more and more critical. That can be expanded into global supply chains as well, right? Where the access to critical minerals, and again, critical minerals that are appropriately sourced is becoming more and more important. That's true even in the US, even as rhetoric in the US is anti-green in some ways. The focus on supporting critical mineral supply chains just continues to grow. So I think that in summary for us, decarbonization isn't about waiting for a cost curve anymore. For investors, it's not about waiting for a cost curve. It's now about building a competitive moat. And as a result, green policy is industrial policy. Yeah, I don't want to go into too much depth there, but that's our sort of high level in the paper. And please check out the details if you're interested.
Thanks. And Jeff, coming to you, and as we start to wrap up, I think it's important to also get to the crux of the conversation around the investment opportunity for this industrialization. You speak about the paper reports or outlines the three-pillar roadmap. Could you take us through it and unpack how the PIC is putting these three pillars into practice, and perhaps through examples around how this framework can crowd in capital from both the private sector and institutional entities?
Sure, thanks, Mosidi. So maybe just to add on to that, from an institutional perspective, looking at the PIC's role, we have quite a unique role in that we manage, a very large amount of public sector funds, largely through our management of the Government Employee Pension Fund, but also our other clients, where we manage, just over 3 trillion rands worth of assets under management, which puts that to about 40% of GDP. We also have a dual mandate as the PIC of achieving sustainable financial returns for our clients, but also delivering socioeconomic development. And I think one of the key things that the PIC does, particularly from an institutional capital perspective, is we de-risk a lot of the early stage investments. A lot of commercial banks and foreign investors are often hesitant to invest in our high risk, long gestation industrial projects. And as the PIC, particularly through our early stage fund, we act as an anchor investment or provider of what they call patient capital in core sectors, not only in manufacturing, but we could also be in mining, especially for, battery minerals, but also in infrastructure such as energy and logistics. At the end of the day, these manufacturers need consistent electricity and they need to get their products out to market. And I think what's quite important is that this signals to the broader investment industry that by directing our capital into new areas like green energy or technology intensive manufacturing, we effectively validate these sectors. And I think it certainly paves the way for future private and international investment. The second pillar, I think, looks at scaling capability through our international partnerships. I think blended finance and co-investment partnerships are quite important, such as the UK's British International Investments are essential for blended financing models. So, for example, the PIC's role, I think, provides domestic currency and capital and local market expertise. And then, from a global perspective, the global financial institutions' roles could certainly be to provide concessionary, dollar-based, or grant-linked funding, as well as, and I think this is quite important, is technical assistance there. And then maybe just to close off and to reiterate on Brian and Pamela's points, there is, reindustrialization is inseparable from the just energy transition. And I think it's quite important that institutional capital and international partnerships must be aligned to this goal.
Picking up on what Jeff has said, Pamela, in your view, how can pension funds and DFIs like yourself, as well as foreign investors, start working together to bring that, key expertise that you all have? And if put together, we can see a lot more kind of mutually beneficial outcomes that speak to catalyzing industrialization.
Thanks, Vasidi. So there are various ways that we can do this. Jeff has spoken to mobilizing, funding, particularly from the international development finance space, and this is something that the IDC has done pretty well. So Brian mentioned the just energy transition. The IDC hosts the green hydrogen and new energy vehicle project management offices, and part of the role that we're playing there is supporting the mobilization of funding. We've mobilized funding for green hydrogen projects, and we've actually already started funding projects in that regard. And what we are recognizing is important is being able to tell the honest picture about where this money needs to go and what are the complexities and nuances that you need to be able to grapple with in these particular industries. So last week, the EU announced that it's committing an additional 230 billion to accelerate South Africa's clean energy transition. And this has been long in the making. There have been discussions that the IDC has been participating in. We've shared our pipeline, with the Department of Trade and Industry to support their engagements with the EU to show that there are projects in this regard that can be funded. So that's us lending our understanding of how these market works, the projects that we are developing over time. Then on the collaboration, the key thing is there's a very good paper that's just come out from one of our partners, which is a London-based research center at SOAS, which talk about the importance of that nexus between institutional funders and development finance institutions. They look at DFIs in Africa and they do a comparative studies with the IDC's Brazilian counterpart, which is commonly referred to as BNDES. And what it was found there is that the funding structure of the development finance institutions is actually critical for determining how they can participate in these industries and how catalytic they can actually become. So BNDES, for instance, about half of their funding comes from from an institutional investor linked something similar to the UIF in South Africa, and they basically have long-term funding that doesn't really have a maturity date. So what this allows you to do is take a long view in this industries, and this is critical, particularly when you're trying to unlock new industries, is being able to take a long view. And something that we haven't quite discussed in this conversation that I'd like to pose to the private sector counterparts on the call is how are we thinking about the trend of financialization of non-financial firms as being a contributing factor to the large cash reserves that we are seeing and insufficient investments. What financialization of non-financial firms does is effectively firms are increasingly taking short-term decisions about investments. There are obviously various factors that affect this, and some of them have been discussed here in this call. So it's been linked to the kind of shorter contracts for CEOs. So someone is thinking about the next 5 years, whereas historically, when there was a really strong drive for industrializations, firms had 20-year investment plans, 30-year investment plans. So if you're thinking about the transition investments that are required, you cannot think about it in 2 years or 5-year terms. You have to be thinking about it in the long term. So how do we start having the conversations with yourselves as the private sector funders, to just see what is required for us to move away from that type of thinking, so that we can do these long-term thinkings, the long-term investments, apologies on that. And then I think we are increasingly working closer and closer with the PIC and look forward to further collaborations around various areas. Last week, I think they announced the Critical Minerals Fund. So we've got a junior mining fund. Perhaps we can work together around that, because a lot of that is focused around critical minerals as well. And that's money that's funded by both the IDC and the Department of Minerals. So the more money we're able to accumulate around that, of course, looking at the various risk and issues that we need to consider in those investments, but pooling that money really allows it to go a lot further. And with the private sector, there's plenty of opportunities for co-investments. One last example I can make is perhaps where the IDC has really been catalytic in terms of the renewable energy investments. So from about 2011, when these investments came up, the private sector didn't really want to touch them because of just how high risk they were. So the IDC as a DFI then really went in, and in a big way, to de-risk those investments. And we've seen, of course, there were also other policy interventions that allowed the projects to be able to be successful. But those were very successful and very profitable for the IDC as well. So taking risk doesn't necessarily mean that you're going to lose the money. There's the risk and return relationship that we're always trying to work out. We've also catalyzed, for instance, the table grape industry in the Northern Cape. It didn't exist. We came in, we worked with particular farmers, and now that industry is exporting to the EU, and the largest grape company in Southern Africa is located in the Northern Cape on the basis of those investments. And again, those investments that have been very good and fruitful for the IDC as well. So it's really, how do we think more carefully around early stage investments? How do we think about creating funds and support for project development? Because some of these things need just a little bit more work before they become bankable. If we only will assess things at the bankability stage, then we are going to lose quite a lot of opportunities. A low-hanging fruit right now are the transmission grid investments. So South Africa is about to roll out its transmission grid to support a consumption of the renewable energy from the northern, western, and eastern Capes. But what that's going to do is create large demand for various components, steel components, machinery and equipment, for the substations, etc. There are plenty of opportunities to finance either the grid or these companies that will be supplying that grid. So how do we look at such opportunities and really lead into them to support industrialization of the country?
Pamela, what are your reflections around what some of the key points Pamela has made for you, Delphine?
Thanks, Pamela, and thanks, Masidi. I think one of the interesting things that stuck with me was the potential for there almost to be a short-termism among institutional capital. I mean, Pamela didn't use those words, but I sort of inferred that. In that, and by that I mean institutional capital can really want to, get all that return quickly, and therefore there can tend to be a misalignment with the nature of the funding required for these projects. And in fact, the irony is that shouldn't exist. I think it's a function of just a point in time. I think it's a function of often the market ending up being more like a voting machine and people getting caught up in, pursuing short-termism. It's a function of how a value chain exists. It's a function of incentives in just how a value chain of return is incentivized to. So if you incentivize, service providers, allocators on short-term targets like 1 year returns, 3 year returns, they tend to then just focus on those. But in truth, institutional capital, particularly if you look at the retirement fund pool of capital, which is by far the largest pool of capital in South Africa, is by its very nature dominated with long duration liabilities, and therefore has the ability to match it with long duration assets. It should not necessarily be obsessed with being overly indexed to public equities whose price is marked on a hourly, minute by minute basis that has to be kind of marked, because the truth is that you have a small cohort of your members that are nearing retirement that need to obviously have certainty over their savings, whereas quite a big whack of your fund has the ability to invest in long duration assets that potentially are perceived as less liquid, but they're not truly less liquid because there's enough that's sitting in more fixed income instruments. So what I really took away, and I think this is potentially a function of the sophistication, the education, the familiarity of the entire value chain that tends to, and when I talk about the value chain, I mean the investment value chain, all the way from the member to the asset owner and the trustee to the consultant to the fund manager to the actual who's making the investment decision, that tends to potentially believe that you have to invest in across the value chain. The understanding can be that you need to invest in something that ticks a whole bunch of boxes that are the known boxes. It must be liquid, it must be mark to market every day, etc. And all of your assets need to be in these types of instruments. The truth is that that's not the case, and that we go back to right at the beginning where we started. What we're really trying to do is build a package of diversified assets that have uncorrelated returns, that have different time horizons. And sometimes I feel as though the actual asset owners, and here I don't mean the IDCs of the world, but really some of the large pension funds outside of the GPF, tend not to be in the rooms when these conversations are happening. It's often the banks that are in the room. So if you think of the renewable energy funding in South Africa, there's been an almost under-indexing of long duration institutional capital that should have funded these transactions. And so the excess returns ended up going to the banking, value chain rather than the institutional capital value chain. So I do think what these conversations are excellent at doing, so you're really starting to put on the table who should be party, who should be asking. Should asset owners be asking their consultants, who they tend to rely on for advice, kind of how are we participating? Show me in the split of my assets, how exactly am I participating in the reindustrialization? What portion? If it's not available in the listed market, which I've said is under-indexed, how can I access it in the private markets? How can I access it in whether it's private debt, private credit, infrastructure funds, etc.? And then put the pressure back to the consultants to create education and knowledge over their own understanding so that they can surface these assets and then co-invest with the likes of the DFIs, etc. So for me, there's a massive education exercise that's required to get people to think much more broadly around the asset class that is available and not just stick to this vanilla narrow mind and also short-term time horizons.
This has been such an interesting conversation, but unfortunately, I have to start wrapping it up. So, in closing, Delphine, as you were talking, I started reflecting around the point of if South Africa was to really, be strategic around reindustrialization and actually having like a firm policy, just as we have around the just transition, in order to kind of power up this latent potential that sits in the job creation and the manufacturing output. What could be some of those focus areas that we could look into?
Thanks, Mosidi. It's a great question. I think at the beginning of the conversation, we already noted that we've got the policy commitment, we have the capital, and I think thanks to our research, we have the analytical framework. I think the single most practical priority now is execution through targeted sectoral focus. So I think for the PIC, I guess the next big opportunity lies in scaling up investment in these strategic sectors that offer high return industrial segments, where South Africa and the region have a structural competitive advantage. I think specifically if we look at mineral beneficiation, I think it's important that we focus on moving beyond just raw exports from agro-processing. We really want to build resilient food supply chains, not only in South Africa, but also in the rest of Africa, where we've seen droughts really causing huge devastation there. And then just in the green manufacturing, we really want to be leveraging the global decarbonization trend. And I think we really, to conclude, is we need to be deliberate. The next industrial boom is not going to be by accident. It'll certainly be sparked by institutional capital, focusing our intensity on these proven value chains. And I think working with partners like the IDC to turn investment strategies into spades in the ground. And I guess that's where the PIC will be concentrating our efforts. Thanks.
Great. Thanks. And Brian, what's the one global lesson in your view that South Africa can take from countries that have turned industrialization aspirations into reality?
Yeah, Masidi, I think to that question and the prior one on what do we need to do now, I think it would be wrong for people to read the paper, listen to this conversation, and to take away that government needs to act in a more beneficial way in order to unlock capital, and that nothing is going to happen without the government taking more of a role. That is not the message. The message is South Africa has latent capacity in its industrial sectors that is there available now to be taken hold of, and that can already unlock differentiated risk-adjusted return. When we look to international spaces, I think what is very clear is there is this risk perception. There's an inappropriate risk perception that has been applied to South Africa that we are now moving beyond, and until and really perception moves faster than policy, right? We will see a repricing event if perception is able to readjust itself to the reality of today. I think the irony is that South Africa's fiscal management, its independent central bank, its rule of law institutions are stronger than most emerging peers. Yet the market prices it like a frontier economy. The market says you need to do X, Y, Z before we can start looking at you again. X, Y, and Z have been happening, are happening right now. The disconnect is pure opportunity. And I think that should be the overall message that we're taking home here.
Thanks, Brian. And Sanisha, coming back to my question around if we had to have a clear policy around the need to industrialize from a macro perspective or policy signal, which ones would make a difference in shaping the investor sentiment for that to kind of really rally behind it?
So I think we need to focus a little bit on how South Africa deals with foreign affairs and international relations. So if we really want our reindustrialization strategy to, get off the ground in a meaningful way, and have the full benefit of having external demand for our goods, then we need to abide by our non-aligned stance. We need to ensure that we do have trade representatives to represent South Africa. We do need to be exposed on that basis to display our competitiveness in a number of markets and to put our best foot forward on a trade stage. So I think, in a world where we are morphing into a new world order, South Africa has to maneuver in that way. I also think that part of the answers in the question that you posed, we've got all these different strategies. How do we put it all together? And we're seeing something very similar on the funding front. So there is, numerous schemes, and we've got taxes and subsidies, and we've got the Black industrialization scheme. There are a number of funds. They've all got their own strategy attached to it. But again, to get a more coordinated response to the reindustrialization strategy, we may need to think about pooling those funds, having a more coherent strategy on board. I think that's maybe where we get the political buy-in for it, the private sector buy-in for it, and the foreigners buy-in for it in order to take it forward. I think by having this very fragmented approach on the strategy, but also fragmented approach on the funding side of things, it does actually almost water down and dilute the opportunity set for us.
And so Delphine and Pamela, coming and closing with both of you. So if we had to take away the fragmentation that Sanisha spoke to and create a unified approach that makes it attractive for your capital to be deployed for reindustrialization, what would be that thing that ignites kind of the need to? I'll start maybe with you, Delphine.
Yeah, that's and great observations and a lot of food for thought. So thank you to the panelists. I think the one thing that really inspired me from something that Brian shared was that one the latent capacity is the capacity is there, it's latent. And so as an institutional owner, we're trusted with money on behalf of institutional capital. And then we invested in the corporates, and we spend a lot of time engaging with the management teams of these target companies. And I guess I was thinking back to our experience on ESG and all of this ESG engagement we have kind of taken on as a value chain over the last decade, especially. And a lot of that came through from desires of the asset owner that pushed down to the asset manager, who then pushed it down to the corporate. And so equally, I wonder why we are not spending more time engaging with our companies that we invest in to say, how much latent capacity do you have truly? What would it take for you to start actually putting that back into engaged use? Because ironically, this is a win-win, because once that capacity starts to be utilized, you start to increase the returns rather than having this depressed level of return on invested capital. And secondly, you actually start to very quickly potentially get to your target of 2030, because we're not asking to lay down huge tracts of manufacturing capacity. We're asking initially just use what is there that is currently not being used. And I think we might, if there's that pressure that comes through the system, which I actually can concede is not happening in terms of the questions we're asking corporates, because we're sort of just accepting their bemoaning the state of lack of energy, but we know that those things have shifted meaningfully. So for me, putting back to you that I think it's something that I want to take on board as an action plan on behalf of kind of the investor community, to say we need to engage more with our South African corporates about what they can do to get that latent capacity to no longer be latent.
Thanks, Delphine. And what are some of your reflections in closing, Pamela?
So my closing remarks really build on what Delphine has said, particularly with regards to how one would think about some of the regulatory requirements such as ESG. So there's a tendency to think about them only from the perspective of compliance, which misses a great opportunity for leveraging such requirements for further growth. So ESG is environmental issues, social issues, and governance. So the IDC Sustainable Industrialization Pathways actually bring these issues together. So we're able, through the way we've selected our pathways, be able to hit both environmental issues and social issues, as well as economic resilience. And of course, the organization is very clear on governance issues that keep up with international standards. Then from a policy perspective, there are three issues that I'd just like to emphasize, which are absolutely critical for industrialization. And these are actually all start with a C, so we can say the three C's that are required from a policy perspective. And so first, it's around capability. So it's very important for the policymakers as well as public agencies such as ourselves to have the capabilities to identify what is feasible and what is required to bring these opportunities into materialization. It's also important for us to act in a coordinated manner. So we need to make systematic decisions that are highly coordinated with clear lines of responsibility. So we've been talking with the PIC, and I've mentioned a few times that we are collaborating with them increasingly. So we can move further as the two institutions if we work in the same direction in terms of driving industrialization, because this allows us to optimize. But we also need to be clear around what role is the IDC playing, and what is the role that the PIC is playing, so that we don't duplicate efforts in that regard as well. Then the third C is really really around credibility of policy and regulation. So once a policy pronouncement is made or a regulation is made, unless there's a really big problem with it, we must enforce those, because on these back of these announcements, in long-term investment decisions are made, and if there are any changes, of course, it may change the economics of that project. So from a policy perspective, I think these are the priorities that can support the industrialization endeavor that we have been talking about. Thank you.
So this brings us to an end, everybody. Thank you so much to our panelists for participating in this really rich discussion and conversation. I cannot wait for everybody to have a view at the paper. It really is a must read. And to you, our viewers, thank you very much for tuning in to this PIC Dialogues. So till the next one, bye for now.
Thank you. Bye.
Thanks, everyone.